market is going to move in a lot of reasons in this, what I'll call this generational stair step. It's a 15 to 20 year horizon. Okay? We tend to move sideways for 15 to 20 years. We tend to move up for 15 to 20 years, sideways up. And so what we encountered in 2000 fits exactly into this stair step fashion. Okay, so how did we get here? What really contributes to whether we're moving up or sideways? And a lot of it is just public policy. So if you believe that the market is a pure reflection of our economy, which over long periods of time it has to be, because that's the fishbowl we're operating in, and we're moving in this way, then a lot of the influences have to do with public policy. And public policymakers do influence the market from a broader sense. They make return on capital expensive or return on capital cheap. How do they make return on capital expensive? Well, when they start competing for capital, right? The bigger the government, the more the government's competing with the private sector. So if we're financing a war, then we're drawing resources away from profitable making, endeavors. So you could either spend $1 million and build an MRI machine and collect $3,500 an hour from it, or spend $1 million, build a bomb and blow it up. Okay, so return on capital is now starting to get harder to achieve because you're competing with the government for those resources. So war and peace is probably one of the biggest factors in determining whether our stock market's going up or sideways. And as far as I can tell, we're not ending the war on terror anytime soon. Okay? Second is public policy. What I mean by that is regulations. How many people in this room think we're going to have fewer regulations over the next couple years than more regulations? Now, I'm not necessarily passing judgment on regulations, but I will tell you the more paperwork that I have to fill out for regulators, the less I'm doing my job to create a profit for the company that I'm in. And, Frank Dodd is going to put a lot of barriers around the financial sector, so we're going to see returns on capital go from the mid-low 20s to likely to be the low teens at best. Okay, so that's another factor. And you can see in the 82 to 80, we had the peace dividend, we had deregulation, trade, we're opening trade barriers. Here, I'm not saying we're facing protectionism, but certainly that's a risk we run as the economy tends to slow. And then energy prices. So if you put it into context, I argue secular sideways market. Well, how do we navigate a secular sideways market? Okay, one is we have to respond to the short term, so 12 to 18 months, because that's about as much visibility as you can have in a market like this. We can't be short-term traders. I can't predict what's going to go on in the market in the next 2 or 3 months. But I can say that generally a cheap market will tend to do better over 12 to 18 months, and an expensive market will tend to do worse over 12 to 18 months. But, we want to evaluate these 5 factors, and I'll take you through them now. Okay, first, valuation. Is the market expensive or cheap? Okay, you can use history. You can compare one against another. You can look at one versus, stocks versus bonds. I'll take you through there. The economy. Is the economy providing a tailwind or a headwind? Certainly, back in March of 2009, when we had unprecedented fiscal stimulus, the government was providing a tailwind. Now, the stimulus has run out, and the economy is going to provide somewhat of a headwind. Liquidity. Is there idle cash on the sidelines that could fuel a rally? And I would argue there is some. Psychology. I think that's just the contrary fear or greed. We can measure that. And then momentum. What is the market's momentum, which is vitally important in a market that's moving on a sideways fashion? Okay, so price to sales ratio, actually not bad. We're at about 1.2 times price to sales. We're certainly a lot lower than we've been for the last decade, and we're about the same price to sales ratio as we were back to 1997. Now, a lot of this is predicated on revenues, sales going up. That's for me. Tell them I'm still going till 11:25. So I would say we're fair price on a valuation basis, but if we see revenues start to decline, there's an assumption that revenues go up every year. The economic backdrop, pretty much in line. We look at new orders minus inventories. Yes? You could, at least on a long-term perspective, or we wait for GNP to cut, or we go sideways for 5 years while the economy catches up. Now, probably 15%, something like that. I mean, but that's not a timing tool. I mean, that's a long-term. And here, this, just to show kind of economic backdrop, kind of in line, orders minus inventories. Leading indicators a little more bullish. Cash on the sidelines. So cash as a percentage of the capitalization of the U.S. stock market, I think is a great indicator to suggest that if the market goes up, we have a lot of investors sitting on the sidelines earning zero that could get caught flat-footed. And this was, to me, the biggest catalyst of that surge we saw in March of 2009. We had, look at that peak. We had roughly 70% of the capitalization of the market sitting on the sidelines in cash. And when things started to move, that was a very powerful fuel to help things get going. That's obviously come down some as the value of the stock market's gone up too. Fear gauge. What I look at is one way to look at fear, investor fear, is the average price to net asset value of closed-end funds. I generally use unlevered closed-end funds, and I take the top. I think this one's the top 10 largest U.S. equity closed-end funds employing no leverage. So you can kind of see, with every seller there has to be a buyer. For every buyer there has to be a seller. And so if everyone's rushing for the exits at once, in a kind of a panicky mode, generally that's going to push the price to net asset value down. You can see at this hysteria that the price to net asset value was as low as a 22% discount. I don't expect to necessarily get there, but you can see we're not quite as nervous or panicky, at least on a historical basis, as we are right now. Also, I look at the American Association of Individual Investors. They survey their members every week, and you can kind of get a gauge here to see if investors are worried, nervous, Boolean. So just one other factor. And then lastly, momentum. As I said, navigating a lost decade, navigating a secular sideways market, momentum has been really a great gauge to tell you when you want to be taking risk in the market or when you want to really sit from the sidelines and watch. And here what we do is we look at the 52-week moving average. This was a weekly series, but if you did daily, it would be a 200-day moving average. And we take 5%, the 5% cushion above it, which is our breakout band, 5% cushion below it, which is our breakdown band, and we say if the market trades below that 5% band of the downside, that means the market's got negative momentum. When the market trades above that 5% boundary to the upside, that means the market's got positive momentum. This works if you buy into the argument we're in a secular sideways market, and you can see these arrows are the buy and sell signal, with the last down arrow occurring the first week of June of this year. If you take other markets, like this is the S&P from 1967 and 1979, it was also a pretty effective way to navigate that market. As of this morning, $1,000 invested in the S&P 500 on a price-only basis, as of this morning, would be over the last 10 years, would be worth about $859. If, on the other hand, you move back and forth between the S&P 500 and 3-month Treasury bills, based on that, just the momentum indicator alone, that strategy would be worth over $1,800. So it's certainly something that you can build yourself and do. And one, again, as long as we believe we're in a secular sideways market, I would encourage you to put something in place. It really just acts as a natural circuit breaker. And what we find is that we're not necessarily taking any more risk or levered risk in an up market. We're just trying to get out of a market that we think could go lower. And so we're really, the risk we run, and this is what I've articulated to our clients, is the risk we run is that we end up with too much cash in a market going up and we miss an opportunity. But I think just about all of our clients would gladly exchange that risk for against avoiding a risk of owning too many risky securities in a market that's going down. So having this kind of a program in place offers you somewhat of a natural circuit breaker. Here, just comparing the two, also the Nikkei from 1988 to 2002. Again, it's just, you know, navigating these sideways markets. Same decision rule. Comparing the emerging markets, right now, you know, if you look at the ratio of price to sales ratios, emerging markets seem expensive relative to the U.S. We would prefer any equity exposure to be in the S&P 500 or international small cap stocks, which is our favorite at the moment. Emerging relative to the S&P, though, did experience a breakout and is continuing to move higher. So we do have roughly a 5% allocation to emerging. Bonds, you know, bonds, depending on what bonds you buy, I mean, Treasury right now, the yields are so low, anyone buying a 10-year has to assume we're going to have no inflation or deflation. So, you know, so there are a lot of assumptions built into bonds that there are, and we still hold high yield. You know, we still hold high yield. We got into high yield in probably the fourth quarter of 2008, and we're holding them because last time we bought high yield, we sold them when they got expensive, and we realized that momentum kept going, and they got more and more expensive. So now high yields are expensive, but we're riding the momentum this time a little bit farther. So high yield preferreds, I think preferreds in financial companies are actually a good deal because, like I said, Frank Dodd, while that's taken the return out of that sector, it's created a utility, right? It's taken a lot of the risk out of there too.